I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more.
I've been getting emails about this over the past couple of days from my subs. So I was going to deal with this yesterday, but I did a live stream, so I'll deal with it today, especially since there's a continuation of this said policy. This is the third time. This is the second time, and the third time was this morning. So I actually deal with both of these articles. Fed steps into repo market to control soaring rates. The Federal Reserve injected cash into money markets Tuesday to pull down interest rates and said it would do so again Wednesday after technical factors led to a sudden shortage of cash. That means the bank liquidity is dried up. Just when I say liquidity, that means there's no free flow of cash between banks again. In other words, the circulation of money or the velocity of money is pretty much ground to a stop. It's frozen up. So the Fed is actually injecting cash into it to actually guarantee that people are going to get their money so that the banks will feel easier about loaning cash back and forth to each other. It was the first time the Fed had taken such actions in the money markets in more than a decade, since 2008, basically. The pressures were related to shortages of funds banks are facing, resulting from an increase in federal borrowing and a central bank's decision to shrink the size of its security holdings in recent years. Its reduced holdings have soaked up funds in the financial system. Separately, the Fed's rate-setting committee began a previously scheduled two-day policy meeting on Tuesday, at which officials are likely to lower the Fed funds range by a quarter percentage point to cushion the economy from a broader global slowdown, a decision unrelated to recent funding market strains. Now, that's probably a lie. The federal funds rate, a key benchmark that influenced borrowing costs throughout the financial system, rose to 2.25% on Monday, up from 2.14% on Friday. The Fed seeks to keep the Fed fund rate in a target range between 2% and 2.25%. In other words, there's a range of overnight borrowing depending on risk and volatility, and they want to keep it in a narrow range because banks are supposed to be able to loan money between each other and feel that it's safe. So a bank will get 2% on its money from the Fed or from the interest rates, and they overnight borrowing to actually shore up deficits when money outflows from a bank. They basically, banks pass money between each other, but we'll get to that. Bids in the Fed funds market reached as high as 5% early Tuesday, according to traders, well above the band. In other words, it basically doubled. Actually, more than doubled, which is bad news. That means there's lack of trust. The Fed funds rate was actually replacement for the LIBOR. Back in 2006, 2007, there was a big LIBOR scandal, and or a LIBOR crisis. And since the LIBOR rates were jumping all over the place, banks refused to actually loan money to each other, and since the interest rates are so high, they actually didn't borrow money from each other. So that froze up the movement of money. And that also froze up the movement of business, because this is a loaned, basically a borrowing and payback system. In other words, I've given that example before. if you buy from a supplier, get a loan to buy money from a supplier. You sell such products to a big box store like Walmart on consignment. Walmart takes 90 days to 120 days to pay you back your money. You take your profit and you pay back the loan, and that's the way it works. What happens when it freezes up? Then the movement of goods and services also stop. So the Fed actually took it out of the Libor's hands and took it upon itself to actually supply liquidity back in 2008. This is what the Fed funds actually do. The New York Fed moved Tuesday morning to inject $53 billion into the banking system through transactions known as repurchase agreements or repo. The bank said Tuesday afternoon it would inject up to $75 billion on Wednesday at 8:15 a.m. Eastern Time. We'll get to that. The first injection is $53 million. That is a chart of the target range where the highest range is supposed to get. That's the bottom. And that is 2.25% is the ceiling above the target range. All of a sudden, this jumped over this, which is well outside the band, as they say. Fed policymakers set their target range to influence a suite of short-term lending rates at which banks lend to each other in overnight markets, but those rates are ultimately determined by the markets. Exactly. Each bank actually determines what is willing to lend its money for and how much. If various operations in the market fail, the Fed funds can deviate significantly from the target. In the short run, this likely only affects market participants who borrow in the overnight markets, but if the strains last long enough, it can affect the rates other businesses and consumers pay. Such deviations also undercut the Fed's ability to keep the expansion on track through monetary policy. In other words, they're losing their grip, such as by lowering rates to provide a boost and raising them to prevent the economy from overheating. Really what they're saying is the Fed is losing its ability to influence markets. The markets are way too big for the Fed. And that's been the question. Rising rates in overnight lending markets are clearly not desirable because they impede the transmission of monetary policy decisions to the rest of the economy. The Fed is likely to continue to provide funding to ensure the smooth operation of repo market for some time to come. In other words, they're the lender of last resort. Although it isn't clear how long that might be, analysts said Tuesday. This in every way, shape, and form is an emergency measure. There wasn't evidence Tuesday of credit market dislocations or other transactions that have followed past periods of distress. That's bullshit. Instead, pressures that sent the Fed funds rate higher are related to monetary and regulatory changes and that created shortages of funds for banks. So that's bullshit also. The Fed hasn't had to intervene in money markets since 2008 because during and after the financial crisis, the Fed flooded the system with reserves. The money banks hold at the Fed, it did this by buying hundreds of billions of treasuries and mortgage-backed securities to spur growth after cutting interest rates to nearly zero. In other words, they took in the bad loans. They bought the bad loans. They bought the bad paper. They held it in trust, and they dropped the interest rate so the banks could make money. In other words, they put the banks on life support, where they held them for like almost 10 years. Reserves over the last 5 years have been declining after the Fed stopped increasing its security holdings later in 2017 after the Fed began shrinking its holdings. Reserves have declined to less than 1.5 trillion last week from a peak of 2.8 trillion. The Fed stopped shrinking its asset holdings last month, but because other Fed liabilities such as currency in circulation and the Treasury's general financing account are rising, reserves are likely to grind lower in the weeks and months ahead. Got to spend more money to keep liquidity. The Fed had said this back in 2008. If nobody's willing to provide liquidity, central banks have to. The EU just did it for Deutsche Bank. It just happened. Remember when I told you about Deutsche Bank? I said beware, because there's always a crack. Deutsche Bank was not Lehman's, but Deutsche Bank was Bear Stearns. In addition, brokers who buy and sell treasuries have more securities on their balance sheets due to increased government bond sales to finance rising government deficits. Partially true. Then on Monday, these strains were aggravated by a series of technical factors. Corporate tax payments were due to U.S. Treasury, and Treasury debt auctions settled, leading to a large transfers of cash from the banking system. It's also bullshit. These payments drained money from the system, and there was no cash sitting on the side waiting to come in, said Luke Crandall, chief economist at financial research firm Reichstone. Meanwhile, post-crisis financial regulations have made short-term money markets less nimble than they used to be. Of course, they did. They wanted to regulate this because they wanted to prevent a lot of loose money that caused the problem. This didn't matter as much when the banking sector was awash in reserves and could absorb the kind of swings witnessed this week. The market doesn't respond to temporary deposit flows as efficiently or fluidly, said Mr. Crandall. Let's skip down and say the origin of the demand for cash was unclear, as traders seeking cash could have been acting on their home or on behalf of as intermediaries for other parties, one trader said. All right. Okay, and this is the last part. New York Fed said late Tuesday it would repeat its $75 billion repurchase Wednesday morning, but many in the market were looking beyond that decision. The market will be waiting to see if the Fed makes this a more permanent part of the playbook. In other words, they're in trouble. There is no liquidity in the market. The liquidity has frozen up again. They just took the banks off of life support. And not long after they start taking the banks off the life support, they start freezing up. And it's gotten to the point where it's ground to a halt. Now the Fed started to reduce rates to actually not shock the system, not shock the patient. It's not shock the banks. But evidently, they didn't lower rates fast enough. This is what Donald Trump was actually screaming about. The Fed not taking it seriously enough. And now there's a shock in the system. In other words, we got turmoil in the markets right now. Basically, if oil and what's going on in Saudi Arabia actually is a shock, because that's going to scare people. Because when oil goes up, oil rates go up, basically fuel costs go up, and commerce starts to restrict, because now it costs companies and people more money to actually get their goods out, and goods rise up. There's less money in the system. That's part of it, but this was coming. This was already coming well before this. Deutsche Bank was already in trouble. I told you about the other four major banks that have all this paper is still locked up in their system that hasn't been rectified. And this is just something that was waiting to happen. So this is a signal, folks. I remember we're going to party like it's 2008. I actually did a video about that. So buckle up and put on your dancing shoes. So let me get to the next article. All right, this is the second part. Fed completes third straight repo auction to avoid short-term rate surge. This is from Market Watch. The New York Federal Reserve Thursday morning completed its third repurchasing operation, or repos, in as many days as stemmed spikes in crucial overnight funding market for financial institutions. Remember that from the last article? It spiked from 2% or 2.5% up to 5%, way outside the band. With the street submitting bids for 83.875 billion, sources said, providing liquidity for Wall Street dealers by temporarily buying securities. Earlier this week, a surge in the repurchasing rate used by the hedge funds and banks to fund their trading operations pushed the Fed funds rate close to the top of the targeted range. The incident has stirred worries that the central bank is at risk of losing its grips over its benchmark interest rate, just like the Libra lost its grip over the rate, because it points to a crisis. On Wednesday, Federal Reserve Chairman Jerome Powell said at a news conference that the central bank is likely to execute similar auctions, and said that he doesn't see the recent jump in overnight money market rates on Monday and Tuesday as having implications for a broader economy or for the economic outlook, nor for our ability to control rates. It's bullshit. Okay. This stuff is going to get out of hand. In fact, it's already out of hand. So I was hoping that we'd get out of 2019 without this stuff starting. And hopefully they can control it and get it back in line, and cooler heads will prevail. When we talk about billions and trillions of dollars, traders are skittish, especially when it comes to losing money. And when you have certain bans or automatic AI programs, that when things get outside of bands, you're going to trigger automatic trading. And everybody's already gun shy because of what happened in 2008. There's not as much confidence in the system. So don't believe this, folks. Don't believe this. Don't believe what he's saying. This is very serious. When I told you about Deutsche Bank, it's very serious. When I told you about the run on the banks in Ghana, I said these are precursors because these are weaker systems. The three banks that basically went under in China, they had to be closed down or actually bought up by the Chinese government. These are cracks in the system. And can they heal these cracks? Maybe. Can they put the banks back on life support so that the system can survive? Perhaps. 2019, get right or get left. Get out of debt. Lower your living cost. Live below your means. Have a backup plan. So if in case there's a dislocation, especially in urban areas, get your bug out bag. I'm not saying that you're going to need it, but if you wake up one day and these cards don't work, or the debit cards don't work, and there's a run on the bank and you're in an urban area with all these hungry people, especially if it's like on a first or something like that, when people get their food stamps, it might not be a nice place to be. This is just me. That's the bottom end. The top end is that you're going to have some recession, that it's going to hurt, that people are going to get put out of work, that people are going to lose their homes or maybe their cars or stuff like that. That's the top end. That's probably going to happen anyway. But the bottom end is much, much worse. So keep an eye on it. Don't sleep on it. And I know it's not nice, but the thing is, it's my job to warn you. It is what it is. But with that, folks, I'm going to jump off here. This is BGS out, and I will see you guys on the next one. Peace.